We will continue with the program. I will share my screen. So we finished yesterday, actually, the first part, the first chapter of the course, Introduction into IFRS. We saw in general what IFRS means, what the content are of IFRS financial statements, a balance sheet, income statement, cash flow statement, and so on. And we saw also that there are basically very few restrictions in terms of presentation of those financial statements. Okay, now today we start the second part, which talks about the consolidation and business combinations in general. Okay, so first of all, what are business combinations? Well, that means that two or more companies collaborate in a certain way, work together. And we have here on this slide three primary forms of business combination. And when I say forms, that means legal forms. And I apply here US terminology. So we have three forms of business combination: statutory merger, statutory consolidation, or stock acquisition. And already a first point that's very important. You see here we talk about consolidation. This is an accounting term, okay? And in accounting we talk about consolidation. Here we use also the term consolidation, statutory consolidation, but here it is a legal term, okay? Therefore, not to be confounded. Actually, as we'll see later, a statutory consolidation, the legal form, does not require an accounting consolidation. So it's different, and it's two different things. Okay, in a statutory merger, what happens? Well, before the merger, we have two independent companies, A and B. And now in the statutory merger, actually the company A will buy all the assets and all the liabilities of company B. And once company B has sold all its assets and all its liabilities, obviously there's nothing left of company B. It is only an empty shell. And that means that usually, therefore, company B, the acquired company, will be liquidated, because there are no more assets, no more liabilities, no more activity in this company. That means after the statutory merger, only one company survives, and this is the company A. Obviously, now the company A is much bigger than it was before, because it includes now all assets and all liabilities of company B. Which means, in other words, legally, company B does not exist anymore, but economically, company B will continue to operate, because company B, for example, the assets and the liabilities are factories, machines, accounts payables, and so on. Well, all those factories and machines will continue to operate, but now they will operate within company A. Okay. So statutory merger, we have two legal entities before the deal. After the deal, only one legal entity remains, but economically, both the activities of A and B continue. All right, that's called a statutory merger. Second form of business combination, a statutory consolidation. Okay. So here we have, similar to the statutory merger, actually, similar principle, but the difference here is that we create a new company C, and now the company C will buy all the assets and all the liabilities of company A and B. And that means after the deal, companies A and B are empty shell, and they may be dissolved. And the only legal entity that will continue to live and to operate is company C. But obviously now company C includes all the assets, all the liabilities, all the activities of companies A and B. Okay, so that means here's the same thing in a statutory consolidation. Before the consolidation, we have two legal entities. After it, we have only one legal entity. But again, the activity of both companies continue to live, okay, or to operate. And we have the third form of business combination, which is a stock acquisition. So here we have our two companies A and B before the deal, before the acquisition. And now, after the stock acquisition, actually, company A will buy shares of company B, and by buying those shares, may take control of company B. And that means before the deal, there are two legal entities. After the stock acquisition, there are also two legal entities, but company B now has lost its independence because company B now is controlled by company A. That means here in a stock acquisition, and that's the difference to a statutory merger or a statutory consolidation. In a stock acquisition, we have before and after the deal two legal entities, whereas in a statutory merger or a statutory consolidation, after the deal, we have only one legal entity. Okay, so that's the legal difference. Economically, however, there is no difference between these three forms of business combinations. In the stock acquisition case, company B is not independent from company A. You have to see economically company A and B together. And indeed, they form a group. Remember, we talked about consolidated financial statements, group financial statements. Well, here A and B form one legal entity, and this legal entity is called a group. Okay. In the statutory consolidation or in the statutory merger case, we have only one legal entity. So here the legal entity is already a group because it includes A and B activity. And here also company C includes A and B activity. Okay, so very important. We have three types, legal forms of business combinations, but economically it is the same thing. It doesn't matter which way you do. We need, and that's what we try in IFRS, but also in many national accounting regulations, national GAAPs. What we need to see is the economic situation, the balance sheet, the income statement, the cash flow statement, and so on, of the of the economic entity. That's what I want to see. Okay. Now, for a statutory merger, there is only a legal entity. So the legal entity and the economic entity are the same. So it's not a problem. Company A will do its accounting, and that is automatically showing all the activities of A and B. So therefore, the accounting is shows already the economic activity of the whole thing. Statutory consolidation, company C will do its accounting, and this accounting will already cover everything, and therefore it's also already showing the economic situation. But in the stock acquisition case, here it's different because here I have two companies doing their individual accounting and nothing that shows me how the group is doing, group accounting or consolidated financial statements. And that means here we need to apply a accounting consolidation, because now I have individual financial statements, but that's not what I want to see. I want to see the situation of the unique economic entity. In order to do this, I need to combine the financial statements of A and B. I need to put them together and do things. And this putting together is called consolidation or accounting consolidation. And I will show you today and tomorrow. I would show you how this accounting consolidation works. Okay, that's what we are doing. In terms of IFRS, the regulation we have to follow here is IFRS number 3. We have exactly the same approach in US accounting, US GAAP. And IFRS number 3 is called accounting for business combinations. That means it's not specifically made for stock acquisition cases. It applies to all forms of business combinations because, as I said before, since economically the three forms are identical, well, the accounting outcome should also be identical. I should not have different numbers just because I do one legal form compared to another. In all three cases, I have the same result. And what is the approach when I do this accounting for business combinations? Basically, I use what is called the purchase or acquisition method. And that means basically I will treat the purchase of a whole company, the acquisition of a whole company, I will treat it exactly the same way as if I bought just individual assets. So basically, the accounting rules here do not make a difference between buying one machine, a single machine, for example, a single asset, or buying a whole company. It's the same thing, because what is a company in the end? A company is a bunch of assets and a bunch of liabilities, and instead of buying them individually, I buy everything in one shot. But the underlying idea is the same. Okay, and when you think about it, usually when you buy a machine, for example, what is the first balance sheet value? No, I buy a machine, so it's an asset, it's a non-current asset, so I have to put the machine in my balance sheet, and to do this, I need to give it a number, a first value. So what is the first value when I buy a machine in my balance sheet? What is the first value? Okay, Hangwu, yeah, that's the accounting entry. There's a movement in cash and fixed assets. That is correct. Okay, but my question is, how do you value the fixed asset? How do I determine the amount of the fixed asset that I put? So your accounting entry is correct, but my question was on the value, the amount. Anyone? I buy an equipment. What is the value of my equipment when I put it first in my balance sheet? Yes, it's the book value. All right. But where do I get the book value from? Who tells me what the book value is of the first time I recognize my equipment or my machine in my balance sheet? Anyone? Here we go. Very good. Yes, purchase price, price of the equipment plus installation fees, transportation cost. Exactly. So that is correct. All your answers are correct. Okay. That means the base point here is the purchase price, obviously, plus, as you say correctly, transportation cost, installation cost, and so on. But at the heart, we have the purchase price. And the purchase price of a machine, just the purchase price, not the transportation cost, not the other cost to operate. The purchase price is based on what? Well, it will be based on the selling price, obviously, and the selling price is based on what? Well, it's based on the market value of the machine. Either it's a new machine, then it will be the selling price, what the supplier think it can sell it for. If it's a used machine, I will negotiate and pay the value or the price for used equipment. And the market value, well, in accounting, we don't use the term market value, really, we use the term fair value. Okay, and that means now I apply the same thing when I buy a company as a whole. When I buy the company, the target company needs to be fair valued, because today I pay a price for this. Okay, the first accounting should be based on the fair value of the assets and the liabilities of the target company that I buy. And that is the starting point. And that's why this method is called the purchase or acquisition method. Okay, that means also I do not care about the book values in the seller balance sheet. Okay, that's the same thing when you buy used machine. The only thing relevant for you, the acquirer, is how much did I pay for the machine. You do not care, and you do not know even what the book values were in the seller's balance sheet. It's not relevant for you. Okay, that's very important. So we look at fair values of the target company. And secondly, when do I determine this fair value, the purchase price, so to speak? I determine this only once, and this is at the date of acquisition. Okay, so it means in an acquisition process, I need to fair value the assets and the liabilities of the target company, but only once, that is at the date of acquisition, which means basically the day I take control. You know, we said we are one way or the other, statutory merger, statutory consolidation, or stock acquisition. One point in time, there is a day, actually a date, where we take control. On that date, that's the purchase date. On that date, I need to determine the fair value of all the assets and liabilities that I purchased. Okay. And then obviously there are some follow-up considerations. So that's why this method here, the principle is called the purchase or acquisition method. And in the following slides, obviously today and tomorrow, I will explain to you more in detail how we do this and how it works. Okay. So now we focus more in the following slides, we focus more on the stock acquisition case, because this is actually where, as I said before, where I need an accounting consolidation, because I have two financial statements and I need to combine them to make it only one set of consolidated financial statements. Therefore, here a small slide to re-explain what we had already yesterday or the day before, the difference between individual and consolidated or group financial statements. So here, for example, we have four legal entities. We have IAG, International Airlines Group, which is located in Spain, actually. We have British Airways, which is located in the UK. We have Iberia, which is a Spanish airline. And we have Vueling, which is also a Spanish low-cost airline. So here we have four legal entities in different countries. Well, each legal entity needs to prepare financial statements. And as we said already, those financial statements are called individual or separate financial statements. That means here I will have four balance sheets, four income statements, four cash flow statements, four times the whole thing. What accounting rules do those companies need to apply when they prepare their financial statements? That depends, of course, in the country in which they are located. So, for example, IAG, Iberia, and Vueling, they are in Spain, so they have to use Spanish GAAP on their individual financial statements. British Airways is a UK company. They can choose if they use UK accounting, UK GAAP, or IFRS. But that means here we have four types of individual financial statements and not necessary with the same accounting regulation. Okay, that's the individual situation. But now actually IAG controls the three other entities, and that's why we call IAG the parent company. So parent company is an accounting term. In general management, we would say it's the holding company, because we have a group and the head of the group is the holding company, but the accounting term is parent company. So the parent company, IAG, controls the three other entities, which means they are not independent from each other, and the four companies together, they form a group. So here specifically, that would be the IAG group. Okay, and the same way we have the Air France group, we have Apple group, we have Google group, or Alphabet, I should say. We have BMW group, and so on and so on. Okay. That means here we are in a form of business combination with stock acquisition, because IAG purchased the stock of British Airways, Iberia, and Vueling. So we are in a stock acquisition case. And therefore, we have four individual financial statements. We need to combine them to one set of group financial statements. And this set are the so-called consolidated financial statements or group financial statements for economic entities. And as we have seen on one of the previous slides, in the European Union, for those consolidated financial statements, companies need to apply IFRS if the entities are listed. So, by the way, what do you think? Which company is here listed? Because remember, in the EU, the IFRSs are only required if the company is listed. But which company are we talking about here? Because I have 4 legal entities, each of those could be listed. So do I need to apply IFRS only when all 4 companies are listed, or what do you think? For which company we need to evaluate or check the listing status that determines the accounting regulation to be applied? The idea? No ideas? Well, it refers to the parent company. So usually in most groups, it's the parent company that is listed. Okay, so here I can buy IAG shares on the stock market. I cannot buy British Airways or Iberia or Wuling shares. However, sometimes it's also possible that several entities are listed. So, for example, the parent company is listed. You have maybe 80% of another company, okay, but the other 20% of Wuling, maybe, I'm not saying this is what's happening, the other 20% of the shares of Wuling can be listed. So sometimes in groups you have the parent company who is listed, but also subsidiaries that are partially listed. However, the fact that the subsidiary is listed does not limit the notion of control. And I will explain this obviously later. Okay, so difference between consolidated and individual financial statements. Individual financial statements give a legal view. Consolidated financial statements give an economic view of the situation. As I said earlier, one of the principles in IFRS is faithful representation, substance over form. Okay, so it's the economic reality that interests me, not the legal one. That's why we need to do consolidation. Okay, so that means here I have a group, okay, potentially, or let's say I have a parent company. The parent company has multiple investments in multitude of companies. Okay, and that means, well, potentially the parent company has to prepare consolidated financial statements. And the process how to prepare those consolidated financial statements is basically a 4-step process that you can see here. First step is to determine the scope of consolidation. Scope of consolidation means basically I have to see which companies are inside the circle, which companies are part of my group, and which companies are not part of my group. Okay, so the scope of consolidation is basically the size of the circle and who is inside the circle or not. And I will explain to you how this works. Then secondly, we need to prepare the individual financial statements of all the companies inside the scope. I need to prepare them for consolidation because, as I said before, okay, I have 4 sets of financial statements, but they're not all IFRS. They're UK GAAP, they're Spanish GAAP. And remember, we need to do this on a worldwide basis. So I will have a multitude of different GAAPs in my group. But in the end, I need consolidated financial statements only in IFRS. That means before I can combine the financial statements, well, I have to harmonize them, which means basically they have to be in IFRS. They have to be in the same currency. That's why I need to do currency translation, and so on. Okay, after the second step, I have a multitude of individual financial statements, but now they're all in IFRS, they're all in the same currency. And now I can put the numbers together. I can combine them. I can do additions, subtractions, and so on. And that's what I do in the third step. That's basically the heart of consolidation. Here I will combine the financial statements in a certain way and prepare the consolidated financial statements. And step number 4, well, I will present the consolidated information, the balance sheet, the income statement, the cash flow statement, and so on, as we have seen it yesterday and the day before, based on the presentation requirements in IFRS. Okay, 4-step process. Step number 1, the scope of consolidation. That means, in other words, here the parent company has to check what type of relationship it has with all the other companies. You are a parent company, you have a multitude of investments, okay? And now you need to check, well, okay, I have an investment in another entity here, but what type of relationship is created by this investment? And there are potentially 4 types of relationship. So 3 types that are listed here, and a 4th type, which is not on the list. Okay, relationship number 1, the one that we mentioned already in the previous slide, it's a controlling relationship. Okay, so the parent company controls the other company, the investee company. Therefore, the investee company will be called a subsidiary. Okay, subsidiaries are within the scope of consolidation. So yes, I need to consolidate subsidiaries. And how will I do this? I will do this by using the consolidation method, or I prefer the second term, the full consolidation method, because later on you will understand that the small word full has a certain meaning. Okay, so subsidiaries are consolidated. I use the full consolidation to consolidate them. Then there is a second type of relationship, significant influence. I will explain this later, which is less strong than controlling, but still those companies are included. And we have a 4th type of relation, a 3rd type, joint control, they're also included, and we have a 4th type that is not included. Okay, before we continue on this, let me talk about the notion of control. Okay, obviously that is very important. You see here, to simplify, we can use the rule that if you have more than 50% of the voting rights of another company, that usually gives you control. So the parent company controls the subsidiary if it has more than 50% of the voting rights. However, in IFRS, the situation is a little bit more complicated. So, for example, here you have an excerpt of the financial report. Remember the universal registration document of the French telco company Orange. They give us a list of the main consolidated entities. So it's not all of them, and there are several pages. So that's just the first part of it. And we see that I include in the scope of consolidation, obviously, the parent company of the group, which is Orange SR. So the holding, the parent company, and all subsidiaries in the world. And we see that here the percentage of voting rights basically that I have, and we see largely it is above 50%, but not all the time. So for example, here you see I have only 37% of the voting rights, 38%, 29%, 49%, 42%, etc. So it means, okay, having more than 50% of the voting rights usually indicates that, yes, we do have control, but you can control another company with less than that. And here's the proof. Orange in Africa and the Middle East controlled certain companies, but with less than 50%. Okay. How is that possible? Any ideas? How can I control another company if I hold only 40%, for example? Do you have ideas? Okay, yes. Song Huin, that's a good idea. You may have an agreement with other shareholders in the company. That is true. A shareholder agreement, that's a possibility. Very good. Okay, something else? Other ideas? How can I control another company with only 40% of the voting rights? Ideas. Or you can control the company through indirect shareholding. That is also true. But obviously that is already included here in the calculation. So here we are not only talking about, when I say 40%, that means direct shareholdings and indirect shareholdings together are only 30%, 40%. Okay, some other people say unless that's 40% is the highest shares owned. So yes, I may be the biggest shareholder. Okay, but still, even if I'm the biggest shareholder, I have 40%, while the other people having 60%. Okay. So let me modify my question. How do you when and how do you exercise your control rights, your voting right? You know, we say that if you have more than 50% of the voting rights, you have control. But where do I exercise my control? When do I do this? You know, like assuming I have 60% of the voting rights, what does that mean? Where do I use those voting rights? When? Yes, exactly. You vote in the shareholder meeting. That's where I can use my voting rights and exercise my voting rights. And now here comes the trick question. Who votes during the shareholder meeting? Appoint a member of board of directors. That is true too, but all this is done in the shareholder meeting. So it comes back to the same point. You exercise your voting rights in the shareholder meeting. But my question now is, who votes in the shareholder meeting? It's a trick question. Well, common shareholders, yes, that is true. But which common shareholders? People that have a right to vote, yes, shares with voting rights. But all of them, do all common shareholders vote? Do all shareholders that do have voting rights, do they vote in the shareholder meeting? Or which ones only? Well, the representative, exactly. Shareholders present in the meeting. Correct. So you exercise your voting right only if you go to the shareholder meeting or if you send somebody else, like a bank, for example, that represents you. That means, well, actually, if I have only 40% of the voting rights, that may be enough to have the majority of votes in the shareholder meeting. Well, because not all shareholders are coming and not all shareholders are represented. For example, in France, the biggest stock market index is the CAC 40. Actually, the average attendance in those shareholder meetings is only 70 to 75%, which means 25 to 30% of shareholders do not come, are not represented in the shareholder meeting. That means if I own 40% of those shares, well, I systematically have the majority of voting rights. And therefore, I would control this company. Okay? So the main point here is to say that in a simplified manner, we can say that if I have more than 50% of the voting right, it is very, very likely that I do have control, but it's not automatic. I can have more than 50% and no control, and I can have less than 50% of the voting rights, but I still control. It's complex. Okay. So I don't know. I don't have statistics on that. Probably in 90% of the cases, if you do have majority of voting rights, you do control, and we are good. But there are 10% of cases where we do not control with more than 50%, or we do control, but we have less than 50%. And here for Orange, actually, you see here there's always a footnote. On all those cases, there's a footnote. And what they mainly have is shareholder agreements, first of all, and secondly, contractual agreements with the company. So not with the other shareholders, but directly with the company. And that gives them control, although they have less than 50% of the voting rights. Okay, we discussed this already. When I consider those voting rights and the percentage, I do not only consider direct ownership, okay, so the parent company has a stake in an entity, but also indirect ownership. So that can be on several levels, so unlimited number of levels, okay. As long as I control all intermediary companies, I also control the company at the very bottom. So if the parent company controls E2 and E2 controls E3, well, that means indirectly the parent company controls E3. And we can do this on many, many levels. There has to be a controlling link on all the levels, and that means the parent company controls everything. Everything counts, not only direct ownership. Sometimes we may have complex situation with reciprocal ownership, for example. So the parent has stake in E4, but E4 has also stake in the parent, which basically could raise the question, well, who is actually the owner of the company? Is PC, is the parent company really the parent company of E4? Or maybe E4 is the parent company? Obviously, here sometimes national corporate law regulations do not allow this situation. In France, for example, there's a rule that says if one company has more than 10% of another company, the other company is not allowed to have an ownership stake. So that would not be possible here if we have more than 10%. But that's a French law. Obviously, in other countries, you may have no regulation whatsoever. What happens in case of circular ownership? So PC has a stake in E5, E5 has a stake in E6, and E6 has a stake in PC. Okay, now in the end, who is the parent company of whom? Has to be considered, and the answer is not necessarily very easy to find and obvious. Okay, so very important. It's not only the direct link that is important, it's all types of links, including contractual agreements, shareholder agreements. All this is relevant to determine if there is control or not. So in IFRS, as I will show you on this slide, the notion of control is actually rather complex. Why is that? Well, because IFRS tries to have a scope of consolidation that is as large as possible. Because as you will see later, any activity of a company that is inside the scope of consolidation can be very well seen in the consolidated balance sheet, income statement, or cash flow statement. Any activity of a company that is outside the scope of consolidation cannot be seen or can be seen only in a very reduced way in the consolidated financial statements. And if I see things only in a reduced way, that means, of course, well, I cannot see the whole truth. Things may be hidden, and so on. And therefore, IFRS tries to make the scope of consolidation as large as possible, because the more we integrate in the consolidated financial statements, the higher is the transparency and the better it is. Therefore, IFRS has developed a notion of control that is very large, and is defined in IFRS number 10. And as you will see on this slide, actually, owning shares is not even mentioned. So having like 60% or 50% of the voting rights is not specifically mentioned to take control. It's much more complex than that. So in IFRS, in order to control a company, three things have to be met, or three criteria have to be met. First one is the parent company needs to have power over the subsidiary. Second element is the parent company needs to be exposed to variable returns. That means what happens in the subsidiary, good or bad, has an impact, good or bad, on the parent company. So on the one hand, I have power. Theoretically, I am exposed to risk. That's the second element. And how do I link the two? Well, that's the third criteria. I have the ability to affect the returns. In other words, I can use my power in order to influence the returns. So I have theoretical power, I'm exposed to returns, and I can make the link because I have the ability to use my power. If those three elements are met, then yes, we do control a company. And once again, you see here, owning shares is not really mentioned. And as we will see later, there are situations where you can control another company and you are not a shareholder at all. You have zero shares, zero voting rights. That's also possible. IFRS number 10 specifies control and power by saying power means that you have substantive rights that give the ability to direct relevant activities. Okay, so here are the two important things. Substantive rights, okay, we have to make a distinction between substantive rights and protective rights. Okay, so let me, because it's better to write somewhere else. Okay, so we have substantive rights, versus rights. So protective rights do not give you power. What are protective rights in general? Protective rights give you the possibility, certain power of the decision making to protect your position. So it's more like a defense. You can veto a decision that would harm your current situation. That is possible. That is a protective right. But a substantive right is a right that you can use actively, you could say, to move the company forward and to improve things, for example. A protective right does not give you the power to improve things. It only gives you the power to avoid that your situation gets worse. So an example for protective rights are, well, let me stay here. Example for protective rights are so-called golden shares. Have you heard this expression? Do you know what a golden share is? golden shares. So that are shares, but apparently they are quite different from regular shares. That's why they're called golden shares. Any idea? Have you heard this term? No? Well, many governments do this now in Europe and elsewhere. So golden share, for example, is a unique share that is held by the government in a strategic company, you know, like airline, defense system, whatever, telecom, and so on. So something that the government thinks is strategic for the company, for the economy. Then the government will hold one share and has only one vote with this share compared to all the other shares. But in certain circumstances, this share gives a veto right to the government. So we could say a golden share is a share with special, in particular, veto rights in certain circumstances. So, for example, the golden share may give you the power to vote against a takeover or a merger. So everybody agrees with the merger, but not the government, so they can use their single share and say, no, I will veto this decision. Okay, this is a golden share. In this case, anyone holding this share has a protective right. Okay, a protective right, as you can see here on the slide, a protective right does not give power. Only substantive right give power. Okay. Substantive rights also include, of course, that will include voting rights that I have because I'm a shareholder. It also would include potential voting rights. Do you have any idea what potential voting rights are? What can give me potential voting rights? Do you have any ideas? So we have actual voting rights because I'm a shareholder, but how about potential voting rights? Where could they come from? People are writing potential voting rights. Okay, they may derive from pledge of non-economic rights and financing transactions. Okay, maybe. I don't know. Yes, golden share is similar to veto. Here we go. Hang Wu indeed writes from convertible instruments, options, and so on. Correctly. Potential voting rights are from convertible bonds, stock options, warrants, and things like that. They count as substantive rights. So in other words, for example, if I have 40% of common shares and I hold convertible bonds that I could convert into another 20%, okay, those additional 20% will count for me and will tell me that I have power actually, which makes sense because I can use them as a negotiation argument with the management of the target company. If they do not do what I want them to do, I can convert my bonds, take the voting rights, and vote them out of office. And obviously, they will consider that. Okay, so substantive rights include also potential voting rights. I need those rights not over all activities of the target company, only about the relevant activities. So relevant activities means the main value drivers of this company. So what is the value driver of the company? Is it the distribution network? Is it the R&D? Is it the production tools, because they have factories in strategic points? Is it the customer contracts or the client data, etc., etc.? So which part of the company is actually the main value driver? And power means I can direct this value driver. I do not need to direct everything. So if I, for example, I control the whole company, but not the logistics, but logistics is not relevant, well, then nobody cares. I will still have power because I control all the rest. Okay, so power is substantive rights over relevant activities. That's what's counting here. Second element, exposure to variable returns. All right, well, that means the investor's return can vary as a result of the investee's performance. Well, here typically we think about a shareholder investment, share investment. Obviously, my return, that means the stock price increase or dividends, will depend on the performance of the company of which I'm holding shares. So here, dividend payments typically would be a variable return. But here, same thing in IFRS, the notion of variable return is very large. For example, a bond, a fixed interest rate bond that you have purchased, that means you are also exposed to variable return. And why is that? How is that possible? So assuming a company has issued a bond, you buy this bond, the bond gives you whatever 5% interest every year. But even despite this fixed interest, we still consider that you are exposed to variable return. Why? Why can the return vary if I buy a 5% bond? Any ideas? So contractually speaking, I will get 5% interest every year. That seems pretty stable. But something can happen that I do not get the 5%. So there is no guarantee that I get the 5%. What can happen that I do not get my 5%? Well, the issue of the bond can go bankrupt. There's a credit risk when I buy a bond. That means, well, there is a variable return because, okay, they promise me to pay me 5%, but there is no guarantee. It means even interest on a fixed rate bond is considered a variable return. Another form of variable return may be a tax advantage. You know, I buy another company, I set up another company in order to get a tax advantage. Okay, well, the tax advantage is not guaranteed because tax laws can change, for example, over time. And finally, I do not get a tax advantage as expected, no? Or I get a lower tax advantage as I thought, etc. Okay, so variable return is not only a return, a dividend return. The notion is very large. Okay, so I have theoretical power. I'm exposed to a variable return, to risk. Number three, I am able to affect the returns, to use my power. And here we use the principal agent theory. And basically, if I'm a principal, that means yes, I do have the ability to affect my returns. If I'm acting only as an agent, no, I do not have the ability. And if I don't have the ability, there's no control. The principal is the one who makes the decision. The agent is someone who only executes a decision, but is not doing a decision on its own. So here are different elements to see if I'm in a principal or in an agent position. For example, how am I compensated for what I'm doing? Is my compensation, does it depend on the performance or is it fixed? If I get a fixed remuneration, independent of any performance, well, that means I'm more acting like an agent. Who What is my scope of authority? What type of decision can I make? Am I completely free in my decision making? Am I in a principle? Or are there some binding rules? Well, then maybe the binding rules make me an agent. Okay, so we have to check this. Okay, when I have power, when I am exposed to a variable return, and when I can affect this variable return, then I have power and I have control, excuse me. Then I have control. The target company is controlled by me. It's called a subsidiary and it will be part of the scope of consolidation. Okay. Questions so far, please? Okay. That's not the case. So it's 8 o'clock for you. Then let's have the dinner break for 30 minutes. So I propose that we meet again at 8:30 for you. Okay? Enjoy your dinner. course. So we are talking about the scope of consolidation, and we discussed here the notion of control, depending on power exposure to variable return and the ability to affect the returns. Okay, let's have a look at the following case here, and the question related to this: who controls whom? So we have company A has a share capital of composed of 100 shares, and the current share price is 12 euros. Company B has a share capital of 60 shares, and the current share price is 40. Now, in a share deal, company A takes over and buys all the shares of company B. And therefore, two questions. The first one is how many shares company A has to issue, and after the share deal, who controls whom? So maybe the first question, what is a share deal? Does anyone know? Compared to the contrary or the opposite would be a cash deal. What is a share deal compared to a cash deal? Any ideas? Share deal versus cash deal. Yes, indeed. Donghuin company issues shares to pay for the acquisition instead of paying cash. That is correct. So company A will issue new shares to pay the shares they're buying by company B, and therefore the question, how many shares company A has to issue? So any ideas on that? How many shares company A has to issue? Can you calculate this? Well, 4 shares is certainly not enough, huh? 200 shares, that's correct. 2,000 shares is a little bit too much, but 200 shares is correct. Okay, why? Well, because company B has 60 shares. Okay, each share has a share price of 40 euros. That means the total value of company B is 2,400. And we will pay those 2,400 with our own shares, and our shares have a value of 12. That means indeed we need to issue 200 new shares. So why do I say here at least? So here we calculated 200 shares. In real life, probably company A would need to issue even more than 200 shares. Can anyone tell us why? Probably. Why is it very likely that company A needs to issue more than 200 shares? Okay, because market prices may change, that is true, but even if market prices stay the same, even then probably I would need to issue more shares. Yes, because we need to pay a premium. Exactly. Huh? Okay, so because if I offer the B shareholders only 40 euros, they have no incentive to sell their shares to me. They could also sell them for 40 euros on the market. So therefore, I need to offer them a premium. That means I will need to issue more than 200 shares. Okay, but here, let's leave it with the 200. Okay. Now the question, after the share deal, who controls whom? So company A bought all the shares of company B. Now the two companies, we are in a stock acquisition case, business combination, all right. But now basically the question is, who is the parent company? Who controls whom? Which obviously is a trick question. So Chung Tran, you say company A controls company B, I guess. Huh? That could be correct, maybe, maybe not. Let's see what some other people think. Now, Hangwu, you tell us B controls A. Can you justify your answer? Why do you think company B controls company A? So Hangwu, the number of shares of B is 200 out of 300. Indeed. So what happens here is, if we look at this case, before the deal, before the deal, A shareholders hold 100 shares. After the deal, well, A shareholders still hold 100 shares, but former B shareholders hold 200 shares. Okay. What does that mean? That means that B shareholders now control A, because they have 2/3 of the shares of A, and indirectly still B, because company A has the majority or all the voting rights of company B. Well, if I control company A, I also control company B. That means as a shareholder, before the deal, I only controlled company B. After the deal, actually, I control company A and B. That means here the real acquirer is company B. That means B controls A. That means B is the parent company here. And in this situation, actually, we speak of a reverse takeover, called reverse takeover. That means it looks like very famous. Know that Fiat, the Italian auto manufacturer, actually acquired Peugeot, the French car manufacturer, and they were forming, now the new group is called Stellantis. So it's the merger of Fiat and Peugeot. But actually, it was a reverse takeover because the former Peugeot shareholders and the management of Peugeot, they are actually running Stellantis. So that's a reverse takeover. Now the question is, why would companies do a reverse takeover? I mean, if B, in our case here, if B wants to buy A, why don't they just buy the shares of A? And then we are good. Why do I need to organize this as a reverse takeover? And there are basically two reasons. The reason number one is getting easy access to stock market listing. Why is that? Well, so imagine company A is an American company and company B is a Vietnamese company. And the Vietnamese company wants to be listed in New York because the biggest stock market in the world. Okay, now the solution for the Vietnamese company B would be, well, go to New York and file for a listing. But this is very long, very costly, and it's not sure that in the end the listing will succeed. Because you have to go to the American stock market regulator, the Securities and Exchange Commission, the SEC, and you have to apply for listing. That means you need to prepare a lot of information. You need 3 years of financial data, etc., etc. So there's a lot of information to be given to the Americans, which is normal because you want to be listed on one of their stock markets. And then the stock market regulator, after you gave them all the information, may still say no. For one reason or the other, they do not accept that you get listed. Okay, so it means it costs a lot of money, it takes a lot of time, and it's not clear if you will get the listing approval. And even if you get the listing approval, now you do list the Vietnamese company in New York, but well, the company is not very well known because it's not an American company, it's a foreign company. And therefore, well, shareholders may be reluctant to buy those shares. Okay, therefore we do a reverse takeover, and we do this with an American company A that is already listed. Now here, what do we decide? We decide that company A buys company B. Well, this transaction does not require any approval by the stock market regulator. It only needs approval by the management of A and maybe by the shareholders of A, because here we're organizing a reverse takeover, obviously. So if company A issues new shares, the shareholders of company A have to agree. So I need only approval by the company A shareholders. Okay. And once we do this reverse takeover, company A is already listed in the US. That means it's known by American shareholders. There's no approval, and I get direct access, so much faster, much cheaper, and much less riskier to the financial markets. And since we wanted to list company B in order to get access to funding, well, now company A can issue bonds or shares in the American stock market or bond market and then channel this money to company B. And that's why we did the whole thing. So reverse takeover is a possibility to get access to stock market listing, and more precisely, mostly to foreign stock market listing, but not only. You could also do the same thing, a reverse takeover in your own country with two local companies. So that's one reason why reverse takeovers are done. And the second reason potentially are taxes. Why? Well, because for taxation, in an acquisition, the target company will be fair valued on the acquisition, and fair value gains will be taxed. Okay. That means company A buys company B. That means company B is here the target company. The target company will be revalued, fair valued, and if there's a revaluation gain, they will have taxes on this. Now, maybe the original idea here was that company B buys company A, but maybe the revaluation gains, hypothetically, are much, much higher for company A. That means if I do the deal in a regular fashion, that means B buys A, well, it means there are much more taxes to be paid. Therefore, I structure this as a reverse takeover. Company B is revalued. The revaluation gains are smaller, and therefore we pay less taxes in this transaction. Okay, so access to stock market listing and taxes are the two main reasons why companies organize reverse takeovers. Okay. So that means the notion of control is based on complex criteria and also the real economic situation. You have to consider this and not the legal form. It's the economic situation that primes and not the legal form. Okay, any question here to the notion of control in general? Now we are done with that. First part of our scope of consolidation. Okay, so control leads to subsidiaries. Subsidiaries are consolidated or fully consolidated. If the type of relationship between the parent company and the subsidiary is less than control, we call this significant influence. Okay, companies that are under significant influence are called associates or associated companies. They are also in the scope of consolidation, so they will be consolidated, but we use a different method. We use the equity method that I will explain a little bit later. Significant influence, and there's also in IAS number 28 a description what that means. Okay, but there's also the assumption that if you have more than 20% of the voting rights, probably there is significant influence. But the same thing applies here that I mentioned already for control. It's a more complex notion, and therefore you need to check out, despite the voting rights that you have, more or less, if you really have significant influence. So based on that, we could say that from 20 to 50% of voting rights, we have significant influence. Over 50% of voting rights, usually we have control. Okay. Third type of relationship, joint control. Okay, so that means a limited number of shareholders together control a third entity. Okay, then this no one has the power to decide alone. We need anonymous voting, basically, between the limited number of shareholders. Then the company that is controlled jointly is called a joint arrangement. And we have two types of joint arrangements, joint ventures or joint operations. Both are consolidated. So joint arrangements are consolidated. Joint ventures are consolidated using the equity method that I will present later. Joint operations are consolidated using some sort of proportionate consolidation. I will not go deeper into this, just one or two sentences. So first of all, what's a difference between joint ventures and joint operations? Same thing in IFRS number 11, you have a more detailed description. We could say, in general, more or less, joint venture usually is given when we have a legal entity. Okay, so we have two shareholders, they create together a third company. The third company probably is a joint venture. Each shareholder has 50-50 in this entity. Basically, it's very often that's a joint venture. A joint operation, usually we're not talking about legal entities, we are talking about individual assets. So, for example, two companies share the use 50-50 of a pipeline, or two companies share the use of a satellite, or of an antenna station in telecom, or of a factory. You know, you have a factory producing an intermediary part. Okay, two companies share the output of this factory, then probably we are in the presence of a joint operation. So joint operations are also consolidated. We use this proportionate consolidation here, sort of, which means actually each partner will account for his part in the asset. So if we share the pipeline use by 50-50, for example, I will account on my balance sheet 50% of the pipeline value. I will account in my income statement for 50% of the pipeline revenues, 50% of the pipeline expenses. So everything is split proportionately. And that's here the sort of proportionate consolidation. It's actually not really a consolidation. It's like a proportionate accounting, actually, that we do. Okay, so either I control, or there is significant influence, or number 3, there is joint control, or number 4, because remember in the beginning I said there are potentially 4 types of relationship. Well, a relationship number 4 is nothing, which means basically, well, it's not control, it's not significant influence, it's not joint control, therefore it's nothing. It's just a financial investment. There's no specific type of relationship. It's just a financial investment, and therefore a financial asset. Okay, which means no consolidation. Okay, nothing to do. I did invest in another company by buying 5%, for example. Okay, well, that's a financial asset. It's in my balance sheet, and I will use the accounting rules for financial assets that I will show you a little bit later. Okay, so 4 types of relationships, 3 types that lead to some sort of consolidation, and the 4th type who does not lead to any consolidation. Okay, so the parent company has a multitude of investments, hundreds of investments in a multitude of companies. They need to classify all those investments, remember direct, indirect relationship and all this, in one of the 4 categories. Obviously, you don't need to do this for all companies every year, because many things do not change from one year to the other. And that means, well, if I have 100% subsidiary last year and nothing changed, well, it's still a subsidiary this year. So I don't need to verify this. So I need to verify only the scope if I have changes. So I buy new companies, or maybe I sell shares, then I need to change. I need to check if the status changes of the investee company, for example. Or I make new investments, then I need to check, okay, what type is the new investment? But I do not need to do this every year for all of my investments. Okay, that's the scope of consolidation. Any question to that so far? No questions on the scope? Someone is writing. Okay, type number 4, that's the question. That means, for example, I buy shares of another company, but my share investment does not give me control. The share investment does not give me significant influence, and it's not joint control either. It's none of the above. For example, if I buy only 5% of another company, 5% usually does not give me control. 5% does not give me significant influence. It's not joint control either. Therefore, it's simply a financial investment and therefore a financial asset. It's a share investment, you could say, not leading to any consolidation, and therefore it's just a financial asset, no consolidation, and you apply just the accounting rules for financial assets that I will explain to you a little bit later. So you could say that usually share investments below 20% would probably be in the category number 4. No? Anything below 20%. Okay. All right, then let's continue. Regarding the scope of consolidation, we have basically two issues, two problems. Well, not really a problem because we have solutions for that. One problem is what happens if we have changes in the scope of consolidation, because those changes actually make a comparison rather complicated. So, for example, let's assume in 2019, we are looking at the group with 130 subsidiaries and a sales revenue for the group. First, group sales revenue, let's specify this, of 10 billion euros or whatever, dollar. Now in 2020, I have the same group, but now the group has 142 subsidiaries because they acquired some, and a sales revenue on the group level of 10 billion. Okay, and now, okay, I check there is a 50% growth in the sales revenue. Okay, very good. But is this really a performance? Did the company really perform in a good way, or the group here? Well, it's hard to say because part of the growth in sales revenue is simply based on the fact that we increased the number of companies that are in the group. And obviously, as we'll see later in consolidation, I will mostly add the numbers of all companies inside the scope. So if I have 130 subsidiaries, I will add the sales revenue of 130 companies. If I have 142 subsidiaries, I will add the sales revenue of 142 companies. Obviously, the final sales revenue will be higher if I have more companies. That means, obviously, the growth here, or part of the growth that I see, is external growth. We call this external growth because I buy out other companies and I have a difficulty to see the organic growth. And that is the real performance. Because buying other companies, that's not a performance. Everybody can do this. But organic growth, that's the real performance. And here, I don't know. Okay. That's the problem when the scope changes. The same thing, if I sell some companies and the scope has been reduced, then, for example, my sales revenue will decrease, my debt level will decrease, etc., etc. So is all this a performance or not? I don't know, because it's simply related to the fact that I bought or sold companies. Okay, so we have a problem of comparability if there are changes in scope. The solution of this is the so-called pro forma information. Okay, however, pro forma information that I see here is not regulated by IFRS. It's not regulated by accounting, actually. It's regulated by the stock market regulators. That means also it applies only for listed companies. So in France, the stock market regulator is called l'Autorité des marchés financiers. Okay, so the French Financial Market Authority, AMF, and they issued a recommendation. So it's not mandatory. And if you follow the recommendation, then you should prepare pro forma information if you have a change of more than 25% in asset sales or operating income. So you make a big acquisition, therefore your assets jump up, your sales or your operating profit increases more than 25%, then you should prepare pro forma information. But other than that, it's not regulated in France. Obviously, you have national regulations. Okay, so what is this pro forma information? Here, if I go back to our example, that means the pro forma is information as if. Okay, I will do as if, I will prepare or present the situation as if. For example, I could prepare the 2020 numbers as if there were only 130 subsidiaries. Okay, that's not the real situation, because in 20 we had actually 142 subsidiaries, but I could calculate hypothetical numbers if in 2020 we had only 130 subs. Or I could calculate the 2019 numbers, and I could assume that there were 142 subs, which obviously is not the truth, because the real situation, because in 2019 we had only 130 companies in our group, but hypothetically I could calculate what would have been the numbers if we had the same 142. And therefore, now I have comparability, because I can compare the 2019 numbers with 130 subsidiaries and the 2020 numbers with the same 130 subsidiaries, one possibility. Or I could compare the 2020 numbers with 142 subsidiaries with the 2019 numbers with the same 142 subsidiaries. So either I can compare with 130, or I can compare the last 2 years with 142. From an analyst perspective, which comparison would you prefer? Compare 2 years based on 130, or compare 2 years based on 142 subsidiaries? What would you prefer? Well, let's make well, no, let's don't do this. So would you prefer 130 or 142 as a comparison basis? Well, okay, let's do this. So do you prefer 142 as comparison basis? Then you can add yes or no. Okay, let's do this. Do you want to compare with 142, or do you want to compare with 130? So what do we have? Well, we have 15 answers. Most of the people prefer the 142, which also would be my preference. Why? Well, because remember, we have the forecasting function of financial statements. We talked about this last time. The forecasting function of financial statements And well, I look at the 20 and 19 numbers in order to do a forecast for 21. In 21, the group is composed of 142 subsidiaries. So therefore, it's better to have 2019 numbers with 142, 2020 numbers with 142, and then I can do a forecast based on the 142. And therefore, that would be the better solution. However, most pro forma regulations or rules do not tell companies how to do it. Okay, so not in France and not everywhere else, anywhere else. So it means companies do whatever they want. Okay, let's see here an example of Lafarge-Holcim. That's out of 2015. So you see here the difficulty of comparing the numbers, because actually the 2014 numbers are Holcim alone. Holcim is a Swiss company. 2014 is Holcim alone. 2015 is Lafarge and Holcim together. Okay, well, obviously, that's why I see here all the numbers increase very heavily, because basically we heavily included the size of what we are talking about. Okay, you see here in the consolidated financial statements, balance sheet, for example, well, total assets almost double because of this acquisition. So very difficult to compare because it's only related to the scope. Same thing for liabilities. Total liabilities almost double from one year to the other. Well, that's because Holcim is a group, Lafarge was another group, and now you have two groups together. Obviously, the total numbers are higher. Okay, therefore, in 2016, in the report, they presented pro forma financial information. And how do they did it? Well, obviously, I have the end of the year 2015 numbers, and now they give me some information as if the merger had occurred already on January 1st of the year and not on July 10. So the official merger date is July 10 of 2015. And now they present numbers what would have been if the merger had happened on January 1st. This is the pro forma information. Okay, so therefore we have the official sales revenue. And obviously, when I buy a company on July 10, only the sales revenue after that date is incorporated in the first year financial statements, because before that date, the company was not part of the group, and therefore any sales revenue is not a group sales revenue. Okay, so therefore I take this sales revenue for only part of the year, and then I add the sales revenue that Lafarge had on its own between January 1st and July 10, which is another 7 billion. And therefore, my pro forma sales revenue actually is 29 billion. So if I had acquired Lafarge on January 1st, basically my sales revenue would have been 30 million. My operating EBITDA would have been 5 billion instead of 3.7. And my net loss, however, would have been 2 billion instead of 1.3 billion because of, well, all those other items that I will not discuss here. Okay, so that means here they do basically the 142 comparison for the income statement only and present some pro forma information here. Any questions on that? On this example here? Okay, there's another one in the next slide. It's of Bayer, German chemicals company. And you see here the changes in the number of consolidated companies. And you see that in 2018, there was a big increase here. 194 companies acquired in addition. So the scope went from 237 at the beginning of the year to 420 at the end of the year. Well, that's 200 more companies basically in the scope. So what happened here? Well, Bayer company acquired Monsanto, the American company, and therefore the scope obviously exploded. And the same day, the same thing as for Holcim, they present as if information if the acquisitions had already been made as of January 1st, not during the year, but January 1st. What would be the pro forma sales revenue? What would be the net profit after taxes, and what would be earnings per share if we had done all this before? So this is the pro forma information. So here also pro forma information that is given on the income statement only, basically. Okay, very nice questions on this pro forma reporting. One issue in terms of scope, and this issue arises when we have big changes in the scope. Obviously, small changes like buying or selling one company in my group is not really a big deal, and does not require pro forma information. No questions here. Okay, then let's look at the second issue, the so-called special purpose entities, special purpose vehicles, variable interest entities, etc. Those are different names for the same situation. So special purpose entities, we could say, is the accounting term that is used in IFRS number 10. Special purpose vehicles is a term for the same thing, but it is more used in finance. Finance, you use SPE or SPV. And variable interest entities is the terminology used in US accounting. But in all three cases, we are talking about the same thing. So let's see, what are special purpose entities or vehicles or variable interest entities? Okay, at the beginning, you have a company. For example, you have a credit card company, American Express, Visa, and so on. Or you have a bank with a mortgage loan portfolio on clients, mortgage loans, commercial mortgage, residential mortgage, whatever. You have that. Or you have a car manufacturer that has a financial activity by making loans to its client in order to buy the cars here. So they have a car loan portfolio. Or you have an airline that wants to finance a new aircraft, or something like that. So there's a variety of cases. Okay, let's see the bank and its mortgage loan portfolio. Okay, mortgage loans usually are relatively long term, so maybe over the next 10, 15, or 20 years. How can the bank make money? Well, obviously they can sit and wait 20 years until the clients have reimbursed or repaid all of their loans. That means I need to wait 20 years. That means I'm subject to credit risk for 20 years. That means I need to respect regulatory ratios for risk limitations over the next 20 years, etc., etc. And maybe what I want to do instead is sell those loans immediately. Package the loan portfolio and sell it. Okay, and because that would speed up my cash inflow from the loans, I would probably not be subject to the credit risk anymore. I would free regulatory capital to do other activities, and could also help me to shift my activity, because maybe I don't want to do mortgage loans anymore. I want to do other business, and instead of waiting 20 years until this is over, I prefer to sell my portfolio. Okay, how can I do this? I can do this by using a special purpose entity. So the special purpose entity will be another legal entity, a separate legal entity, and it will be created by a sponsor. So the sponsor is the founding shareholder of the SPE, But the sponsor actually usually will be a law firm, some lawyers, and they will only do the administration of the SPE. That means obviously the SPE is a company, a legal entity, so it needs statutes. The founding shareholders have to pay in some money. So the sponsors here will do this, but they will just pay the legal minimum that I need to create a company. So 1,000 euros, 10,000 euros, or in Vietnam, I don't know what the minimum legal requirement is to create a company. So the sponsor basically is not a real shareholder. The sponsor will not get dividends out of the SPE. He is merely providing an administrative service, and for this he will get a fixed fee, basically. Okay. But the sponsor will create the legal entity, and now I have a special purpose entity. And as the name indicates, this entity has a special purpose. We could also say a single purpose and one purpose only. And this purpose will be, in the end, to buy the loan portfolio from our company, or to finance the aircraft, or to buy the car loan portfolio, and so on. And that means this company here will only do one acquisition. They will pay once and buy once the loan portfolio. That's all they will do. Then they will wait until all the people reimburse their loans. And when all the loans have been reimbursed, the SPE will be dissolved. They will not buy a second loan portfolio. They will not do anything else than cashing in on those loans. That's why it's called special purpose entity. So they will not buy, it's not an investment fund that invests in multiple loan portfolios or something like that. That's only once. Okay, but in order to buy the loan portfolio, the special purpose entity obviously needs money, a lot of money. The money does not come from the shareholder because the shareholder give you just a legal minimum. That means we need to go to the financial markets and raise the money, mostly with bonds. That means the SPE will be highly leveraged. But before we do this, we will ask an insurance company for insurance or credit risk insurance, more precisely. Okay, so therefore the SPE buys a loan portfolio. I will buy an insurance against any losses on the loan portfolio. I will also go to a rating agency, Standard & Poor's, Moody's, and so on. And I ask for a rating, obviously, of my company. And the rating of my company will be based on the quality of my loan portfolio. Remember, I have only one asset. Well, it's a multitude of individual assets, but only one type of asset, the loan portfolio. So if the rating agency can give an opinion on the credit quality of my loan clients in that portfolio, they can give me a rating. And hopefully it's a very good rating, since in addition I have insurance. All this should drive up my rating. And now I have insurance, I have a very good rating. And with that, I go to the investors in the financial markets. As I said before, mostly the SPEs will be financed with debt. And therefore here mostly we are talking about bond investors. Okay, not shareholders. There's only one shareholder. It's a sponsor. We are talking about bond investors. And I will issue as many bonds as I need money to buy the original loan portfolio. Now, once I have the money, I go back to the original company, and in the sales transaction here, the company sells the loan portfolio to the SPE. The SPE pays cash to the company. Or maybe the company is an airline, and then the SPE will buy the aircraft and will rent it to the company, and will rent it for 25 years. So it means basically the whole useful life of the aircraft. And then if we talk about the loan portfolio, the company obviously owes a third party, a service agent, will cash in the money from the loan clients. Remember, the clients still pay, but this money obviously goes to the SPE. This money now is not destined for the company anymore. and the SPE will take this loan money and pay the bond investors, obviously, because they get interest, they are reimbursed, they pay the rating agency, they need to pay insurance, and they need to pay with a fixed amount the sponsor. So all this is obviously calculated. How much money do I need for all of this? How much does the service agent get, and so on. Okay, that's the structure of special purpose entities. Okay, so now, and special purpose entities is a common financing tool, is widely used everywhere in the world, although it has lost a lot of reputation in the subprime crisis in 2008, 2009, 2010, the financial crisis here, because it was the same model here, and the banks were selling mortgage loans to SPEs, and those SPEs, well, all this was exaggerated, and as you know, a lot of banks and SPEs and mortgage loans failed, and pulled down the whole economy. Well, not only in the Western Hemisphere, but more or less worldwide. Well, in many countries that were heavily involved in this type of financing. So SPEs since then have a bad reputation, but it's still a tool that is widely used, and if you use it correctly, there's no problems with all financial innovation. If you exaggerate, well, that's not good, and may lead to losses. Okay, what is the accounting question here? Well, actually, for a long time, in terms of accounting regulation, SPEs were considered of being outside the scope of consolidation. That means the company could set up an SPE or arrange to set up an SPE, but since the company was not a shareholder, was not the sponsor, was not the shareholder, well, the SPE was considered of being not part of the scope of consolidation, and therefore the SPE was not visible as it was not on any balance sheet. Now, since 15, 20 years ago, the accounting regulation has changed. And today, remember, control, that's one reason, by the way, control is not necessarily based on the notion of being a shareholder. Control means, do I have power? Am I exposed to variable returns? Do I have the ability to affect the returns? This is to determine the scope. That's why today, most SPEs actually will be consolidated. They are in the scope of consolidation. It is much harder today. It's still possible, okay, but it's much harder today to organize a so-called deconsolidating SPE. Okay, that means most SPEs today are consolidated, and that means basically, okay, as a company, I can sell the loan portfolio to the SPE, but since the SPE is consolidated in the consolidated balance sheet, I will still see the loan portfolio. Or as an airline company, instead of buying the aircraft myself, I can make an SPE buy the aircraft and rent it to me, but I will still see in the consolidated balance sheet the aircraft because the SPE is a subsidiary, while all assets of the subsidiaries are in the consolidated balance sheet. So from an accounting perspective, therefore, if this is a consolidated SPE, accounting-wise, it's not working anymore. It doesn't make any difference. If the asset is within the SPE or within the company, in both cases, we will see it on the balance sheet. So you cannot make disappear assets and liabilities, revenues and expenses by setting up an SPE in a faraway company. Accounting-wise, this does not work anymore. However, companies still do use SPEs, and they do this then for other reasons than accounting reasons. And obviously, one reason is taxation, tax reasons. And in many countries, you have, not in many countries, but in some countries, you have tax incentives to do that. For example, in the airline industry, they use a lot of SPEs in Japan, in France, etc., because there's a thing called Japanese lease or French lease or Austrian lease from Austria in Europe. And in all those cases, actually, what's happening is that you get a tax break if you locate the SPE in Japan or if you locate the SPE in France, etc. So it is a tax advantage of doing this. Okay, any question on SPEs, please? No questions? SPEs? Okay, then let's see on the next slide. Here we have notes of the Lufthansa Group, so airline, here 2019, not 2020, because of COVID, 2020 was not a normal year, but 2019 was. And you can see here that in terms of group of consolidated companies, there are many companies that are added on January 17, all of them. And you see they're all located in Japan. So in one day, they incorporated into the group 5 new subsidiaries. And you see the name of those subsidiaries is not very inventive. Aircraft number 17, 18, 19, 15, 16. Well, that means you know already what's happening here. We are talking about special purpose entities that bought an aircraft and rented the aircraft to Lufthansa, but they're part of the group. You see here we have many companies, several companies here incorporated on August 19. They're all located in Austria. And you see they have the name leasing number 40, number 41, number 42. That means Lufthansa is doing this so often that they run out of ideas how to name it. And that's why they just give it numbers. Okay. And you see also that some companies are liquidated. Some of them the same day and different dates. Here we have 3 companies that are liquidated or sold on the same day, and you see they're all in Japan. And you see here Yamasa Aircraft number 4, Kranich Limited, and so on, which means here what happened? Well, either the aircraft that was in this company here could not be used anymore, or the aircraft was sold. And therefore, well, we liquidate the special purpose entity. We don't need it anymore. So you see they do this quite often. In 2020, because it was not a normal year, they do this much less often. And you see there are more selling things because they know they have to reduce in size. And therefore here they are selling some aircraft, for example, and also some other assets related to the catering business. And still for 2020, if I look at the main subsidiaries, I can see that some of those companies, well, they are in my group, although my equity stake is 0. Well, that's exactly what we have with special purpose entities. And here you see it's the same thing. All those entities, all those are special purpose entities, which means they are part of my group because I control them. I control them even though I'm not at all a shareholder. I have 0 shares. But actually the SPE is completely controlled by me because I have complete power. I set up the company. Well, I tell the sponsor how to set up the company. I decide what's going on and so on. So clearly I do have control of those companies. Although, once again, I repeat, I am not a shareholder of any of those SPEs. Okay. That's it on special purpose entities. Any questions on this? And therefore, we are done with the scope of consolidation. First step in my consolidation process. Any questions? No, No questions? Okay, then let's continue. And we are moving to the second step. Okay, so after the first step, now I know all the companies that are inside my group that are part of the scope of consolidation. I know if there are subsidiaries, if there are associated companies, joint arrangements, or nothing at all. Of course, if there are nothing at all, I don't need to consolidate. But for all the others, I will continue with the second step. And that means as a raw material, that's important to understand. As a raw material, I use always the individual financial statements of all my group entities. Okay, so in other words, I don't have a daily consolidated accounting. There are no people working on a daily basis in consolidated accounting. I have accountants in all my subsidiaries, and on a daily basis, they do the individual accounting. But the consolidated accounting exists only at specific dates when I want to prepare consolidated financial statements. That means basically at the end of the year, at the end of the quarter, for example, for quarterly information, obviously. And that means my starting point will always be the individual financial statements. And before I can combine them, as I said, I need to prepare them for consolidation. So the second step involves different subparts. So for example, one of them I mentioned already is I need to change the individual numbers to IFRS if the individual numbers are based on local accounting regulation, local GAAP, which in many parts of the world will be the case. So that means obviously in Vietnamese accounting, you do certain things, okay? In IFRS, you do them differently. And that means leads to different numbers, different information, and I need to change all that. In particular, I need to delete, I could say, or I need to modify any accounting entry that I did because of tax regulation. So I guess in Vietnam, similarly to continental Europe, for example, many individual accounting treatments are based on the tax laws. So the French tax laws, for example. And if you want, for example, depreciation, that depreciation is recognized for tax purposes, you need in your accounting system, you need to apply the tax depreciation. Otherwise, it's not working. Okay, for IFRS consolidated financial statements or IFRS statements in general, this is not acceptable because in IFRS, you want to show the economic reality and you want to show the economic situation and performance of a company. Tax laws do not have the purpose to show the economic reality. Tax laws have the purpose to raise taxes for the government and eventually to give incentives to people to behave in a certain way or not. But the purpose of tax laws is not to show the economic reality. Therefore, in IFRS, you cannot use a tax treatment as a justification. That is not possible. So you cannot say in my accounting I do this and that because the tax laws tell me to do so. In IFRS, that is not acceptable. The only reasoning in IFRS that is accepted is because the economic reality is a certain way. That's why I do the accounting treatment. That means probably some of the changes here imply to cancel tax treatments that I had. Okay. Basically, this job here will be done on the level of the subsidiary. So maybe some of you work for subsidiaries of foreign groups in accounting or in finance or controlling. And that means you need to send the numbers to the parent company, wherever that is. And the numbers have to be based on IFRS. So the parent company will ask the local accountants to switch from local accounting to IFRS, which is much easier because Vietnamese accountants, they know Vietnamese accounting. They train in IFRS, and therefore they know what the differences are between Vietnamese accounting and IFRS. And the Italian accountants, they know the difference between Italian accounting and IFRS. So it's much easier to do it on the subsidiary level instead of that the parent company is doing this, because that would mean you would need expertise on the parent company level for all the countries in the world where you have subsidiaries, which basically is impossible. So usually the subsidiaries are doing this change. Okay, so I changed from local accounting to IFRS, so I need to redo and recheck all my transactions. And then everything is IFRS. Inside IFRS, I need to apply uniform accounting policies. So that is also something I need to harmonize in the second step. Remember, the consolidated IFRS financial statements show me the economic situation of the economic entity that is the group. Okay, well, the accounting treatment within this economic entity has to be uniform worldwide. So if you think about an airline, so the airline has aircraft, the aircraft needs to be depreciated. Well, this depreciation should be the same within the same group, independently of where the aircraft is located. So I don't care if the aircraft is in France or in Vietnam or somewhere else. It's the same aircraft that is used the same way in the group. Therefore, I need the same depreciation. I cannot have in France a straight line depreciation, and for the same aircraft in Vietnam, I use accelerated depreciation, or I depreciate over 25 years in Vietnam and the same aircraft over 20 years in France. That's not possible. Okay, so I need to harmonize this. The same type of asset that is used the same way needs the same accounting treatment all over the world, worldwide. Doesn't matter. Only when I have the same asset that is used differently, then potentially it may be possible to apply different accounting policies. Okay, so change to IFRS. All right, harmonize everything inside IFRS. And then last but not least, change the currency, because the consolidated financial statements have to be in the currency of the parent company. Okay, so if it's in Europe, you have euro, or the UK, you have British pounds, Japanese yen, US dollar, etc., all depending on where the subsidiary is. So this conversion is pretty much straightforward. You take the IFRS balance sheet after harmonization and everything. You take this and you convert with the exchange rate at the end of the year. Well, actually, it's a little bit more complicated than that, but basically it can be automatized in the system. So it's not something that you need to do manually. And once I did this, after the second step here, what do I have? I have all my subsidiary financial statements. They are all in IFRS. They are all in the same currency. And that means now I can combine them. I can mix them. I can do things because we have harmonized the basis or the rule book of all the accounting numbers. Now that's the purpose of the second step. Okay, so step one, what's the scope of consolidation? Step two, prepare the financial statement of companies inside the scope for the consolidation. And step three, and that's what we'll see now, is we do the actual consolidation. Okay, so what does consolidation mean? So here again, we talk about accounting consolidation. That is only necessary in a stock acquisition type business combination, not in the other case. So basically, in the full consolidation that I do, I have integration of 100% of the subsidiary numbers and I have elimination of group internal transactions. So these are the two main parts of the consolidation. All right. So let's see how this works in this very first case here. Okay, the parent company acquires 100% of S shares for 150. So here I have the individual balance sheet of the parent company. So it's in IFRS, it's in the same currency, we're all good. And on the asset side of this balance sheet, I see the investment in the subsidiary at purchase price, which is 150. I also see some other assets and liabilities. Here I have the individual balance sheet of the subsidiary, which is in Vietnam, okay, in IFRS, in euro, same currency, and I see the assets, equity, and liabilities as given after individual accounting, but based on IFRS. Okay, here's my question for you. Why did the parent company pay 150 to buy 100% of the S shares? So the purchase price of 150 is not an accident, it's a number chosen on purpose. Not 140, it's not 160, it's precisely 150. So my question, why did they pay 150 and not more and not less? What do you think? Ang Wu has the answer. Well, because the equity of S is 150. And this indeed is the correct answer. Because equity is also what we call the book value of a company. The book value of the company, what's the value of the company according to its accounting books? Well, it's all the assets that this company owns minus liabilities. Well, remember in my basic balance sheet equation, assets minus liabilities equal equity. So equity is the book value of the company. That means here in this first case, we assume that the acquisition was done at book value. All right. So you know probably if you have already done a valuation, there's a multitude of methods how to value a company. The book value is certainly not the most appropriate method to do this. But many times, actually, when you value before you do an acquisition and even after you proceeded with the acquisition, you present different values, huh? And then you explain why you paid 150 or why you paid more than 150 to buy this company. And it's standard procedure to present at least the accounting value of the company and the book value. And in some countries, such as France, for example, it is mandatory to consider the book value. I mean, to calculate it. It's not mandatory to pay the book value, obviously, but in your valuation process, you will have the book value, will have a discounted cash flow method. You may have a multiple approach of valuing the company and so on. Okay. And we could say that the book value probably is the minimum selling price in many cases. So it's like the minimum selling price because the old shareholders of S, when they sell their company, they will ask you to pay them at least the book value. Probably they will ask you to pay much more or more than the book value. But here, let's get started and assume that the acquisition was done at book value. Okay. All this is preliminary. Now, in my consolidation process, first step, I integrate the parent and the subsidiary numbers. and therefore I create a combined balance sheet. In the combined balance sheet, I add up all the assets, all the liabilities, so there's no thinking to do, nothing to think about. I do the same thing in the income statement. I'm not showing this here because there's not enough space on my slides. So in the income statement, I have revenues and expenses. I add line by line the sales revenue and all the other revenues and all the expenses. Okay. So here in the combined balance sheet, I have the investment of S, I have the assets of the parent company and the assets of the subsidiary. I have liabilities of both companies and I have equity of both companies. So everything is just added up. Okay. Step number 2, I eliminate group internal transactions. Actually, what I want to do in consolidation, if I go back to my original slide here, what I want to do in consolidation is I want to treat this as the economic entity. Okay, all transactions that happen inside the entity are not relevant. That's like, in the same company, moving the inventory from the second to the third floor, that's not really a transaction, and it doesn't matter. The inventory is still in the company. So here I apply the same view, but for the whole group. So if there are sales between group companies or transactions between group companies, they do not count. Okay, well, they do not count because they are in the same group. So it's not a real transaction. What is a real transaction are all the transactions that any one of the group does with the outside world. So that means a consolidated sales revenue is a sales revenue that I generate with a client that is outside of the group. That's a sales revenue. There can be no sales revenue between two group companies. Does not exist because it's not really a sale. So therefore, consolidated sales revenue means outside clients. Consolidated accounts receivable means, well, outside clients owe me money. Consolidated accounts payable means I have debt to outside suppliers. Okay, so in the end, in my consolidated financial statements, I want to see only transactions that relate to the outside world. And in order to get there, well, since I add up all the numbers in the first place, that includes internal as well as external transactions. In the next step, and that's the heart of the consolidation, I need to eliminate all group internal transactions and relationships. That means I need to check in the combined balance sheet what is internal, what is external. And then I see, okay, the investment here is not an investment in a company that is outside of the group. It's an investment in a company that is inside the scope of consolidation. Therefore, the investment is internal and needs to be deleted. So minus 150 on the asset side. We need to do double entry accounting, double entry bookkeeping. So if I take off 150 on the asset side, I need to put the 150 somewhere else. Remember the same number twice somewhere. Well, here I check and I can say, well, the equity of the subsidiary has not been provided by outside shareholders. That means you and me as shareholders. No, the equity of the subsidiary has been provided by the parent company. And therefore, it's not outside equity, it's internal equity. And therefore, this equity must go. Okay, here in this example, I have no other information on internal transactions, and therefore we are done. We are finished. And I get my consolidated balance sheet. I see all the assets that this group controls all over the world. I don't care where it is located. I don't know if it's a parent company in the subsidiary, in which country, and so on. I see all the assets that this company controls. I see all the liabilities that the company has. So I cannot hide liabilities because I put them in a subsidiary that is far away. Consolidation is a worldwide requirement. Therefore, I will see total liabilities. And here, the first equity that I see is the equity of the parent company only. Over time, this may evolve. But here in the first consolidation, the consolidated equity equals the parent company equity. Okay, and then we are done. This is the consolidated balance sheet. I do the same thing in the income statement. I add up all the numbers. I check if there are internal numbers, internal transactions. If there are, I need to delete them, and then I'm done. In the balance sheet, as we can see here, this consolidation entry, so delete the investment and delete the equity of the subsidiary at the date of acquisition. That is important, equity at the date of acquisition. This consolidation entry here in red is the basic one that you will always have. So in any consolidation, there's at least this minimum operation to do. Okay. Other than that, obviously, it depends on how many internal transactions you have. And here we have said there are no others. Therefore, I am done immediately. Okay, so very important. Do you have questions on this first example? Please. Any questions on the procedure? Okay, doesn't seem the case. So let's enhance the example a little bit and assume that, okay, the parent company here has other assets. And in these other assets, there's an accounts receivable included of 20, let's say. So a claim on a client, and the client is actually the subsidiary. So it's an account receivable on a subsidiary for the amount of 20, which is included here. That means obviously it's an internal account receivable, so I would need to delete here 20, because those receivables should not appear in the balance sheet. But if I delete 20 in the other assets, I need to put 20 somewhere else. And the question is where? What do I do? So I have an accounts receivable of 20 on the asset side, needs to be consolidated, needs to be deleted. What else do I delete in order to, balance my balance sheet? Any ideas? Okay, we have one answer. Remove 20 in liabilities. I wait a little bit before we discuss. Remove from accounts payable in subsidiaries, so it's the same answer. And it's correct. Both of you are right. Because if the parent company has a receivable, that means here for the subsidiary, it's a liability. And that means this liability here of 20 is also an internal liability, and therefore I would need to reduce the overall liabilities by 20. So minus 20 on the asset side, minus 20 on the liability side. My balance sheet is balanced and our consolidation entry is good. That means, as you can see here from this example, most of the consolidation entries are pretty much straightforward, because mostly when something is an asset for one party, it's a liability for another party. If it's a revenue for me, probably it's an expense for you, etc. So if we have an internal sale, for example, then I will cut my sales revenue and you will cut your expenses because you purchased something. So most of the consolidation entries, the eliminating entries here in consolidation are pretty much straightforward. It's like mirror accounting. Of course, we can have more complex cases. So what happens if I sell you inventory with a margin and you resold part of the inventory on the market, but part of the inventory is still within you, is still held by you. How do I do this? Then obviously we have some more complex considerations. And you can imagine that if you have a group that is strongly vertically integrated, you have tons and tons of internal transactions. So think about an oil company who does everything from oil extraction down to the gas station. So you can imagine there's a multitude of internal transactions for consolidated financial statements. All those internal transactions need to be eliminated. And I will do this with the help of my information system, where I will try to identify internal accounts receivable right away. So that already during the year, when the parent company is doing the accounting, they will tell the accounting software that this receivable is a special receivable because it's related to a subsidiary, which means, well, the software knows at the end of the year, I need to delete this. And the subsidiary will do the same thing for the accounts payable and would say, okay, this is a specific accounts payable because it's group internal. Okay, that's how we do things. Questions so far on this first consolidation example? Okay, so if that's not the case, then what we will do next actually is to do the first case. Exercise number 1, but since well, time has run out, we'll start of this tomorrow. Okay, so if you have time, you can already read through exercise 1, in particular the B part. So you should be able to do this now that you have seen the slide, the B part. Other than that, we will deal with that tomorrow. Okay, any final question for today, please? If not, we are done and we can leave it for the day. Some people are writing, but do you have questions? Question. Okay, I guess you have no more questions. Anyway, we meet again tomorrow. So thank you very much. Have a nice evening.